The housing industry is on a mortgage rate roller coaster as the housing market pulls yet another head fake. With interest rates moving back towards 7%, we've seen home buyer demand cool to the lowest level since 1995. On top of that, we've seen mortgage demand drop to a 28-year low. But on the flip side, we saw U.S. pending home sales rise sharply in January, blowing past expectations as buyers jump on lower interest rates, causing home sales to jump nearly 8.1% from December. So we've seen what the market will do if interest rates start to come down, but what does the housing market look like if interest rates stay where they are now and potentially rise even further? Well, that's exactly what we're going to talk about in today's video. We're going to talk about what caused interest rates to rise again from the recent lows that we saw back in January, in addition to talking about what could cause interest rates to come back down and how that might affect you as a buyer or seller in today's market. Now, before we dive into all that information, I want to take a minute and ask a favor. If you find any value in the time, effort, and energy I put into these videos, do me a favor and hit that thumbs up, and feel free to subscribe to the channel to stay updated on everything real estate related. So what caused interest rates to go up? Well, last week we got the latest data from the core PCE, which is really the Fed's key measure of inflation. While everybody out there is talking about CPI, the Fed really likes to look at PCE. Now, they haven't been looking at PCE because of how some of the calculations started coming out towards the later part of last summer. They more or less switched to looking at the core CPI, but prior to that, they have always followed the core PCE, which rose 0.6% in January, suggesting that inflation is still accelerating even with all of the interest rate hikes that they've done. Now, keep in mind, this is the largest monthly gain in inflation in the PCE since June of last year. At the same time, we saw consumer spending jump in January, likely leaving the Fed on track to keep raising interest rates. In fact, we still have members of the Fed, Bostic and Kashkari, calling for higher interest rates after concerning inflation and jobs data, saying more aggressive interest rate hikes are likely necessary to slow inflation. On top of that, Kashkari said this past Wednesday that he is remaining open-minded about whether the Fed should raise rates by 25 or 50 basis points at its next policy meeting on March 22nd. So inflation looks to be heading higher. The Fed is talking about needing to continue to raise rates in order to tame inflation. And then we have Bank of America Global Research saying that the Fed may need to raise as high as 6%. So here's what we know about inflation and interest rates. As inflation goes up, interest rates tend to follow. So what happened in January is we got the numbers from the December inflation report, which showed that inflation was moderating. And because of that, it looked like the Fed might be able to take their foot off the gas pedal with regards to continuing to hike Fed funds rate and be less hawkish, have a less hawkish stance overall. And the market liked the idea of that. And with that, we saw less volatility in the market. We saw the 10-year start to trend down. We saw interest rates move back down somewhere in the mid 5% range. And because of that, we saw this huge pickup in buyer demand. Buyers started coming out of the woodworks, buying properties. We were seeing multiple offers on properties. We were seeing things move very, very quickly. And that's the reason that we saw pending home sales jump nearly 8.1% in January because of those lower rates. But since then, we've had disappointing inflation data. The core CPI data was much higher than economists had expected. On top of that, the PCE data was higher than expected. So it looks like inflation is still running out of control. So as inflation looks to be running out of control, interest rates are more or less following inflation. We've talked about that. If you want interest rates to come down, we need inflation to come down. But if inflation continues to go up, interest rates are going to follow, which is going to continue to put pressure not only on housing, but everything around us. And at the same time, if inflation continues to go up, that gives the Fed more and more authority to continue to hike the Fed funds rate, especially since the job market continues to look really, really strong on paper. So in order to get lower interest rates, we need inflation to come down. We need bad news with regards to the economy. Bad news gives us lower interest rates. Now, at the end of the day, we don't want to go into a recession, but I think the likelihood of us headed into a recession is very, very high. Even though currently on paper, it looks like the job market, wages, everything is remaining really resilient. So what I'd like to do now is talk a little bit about inflation, why the inflation numbers are coming in a little bit higher than what people expected, and when you're likely to see a big change in those numbers, because until you see a big change, we're likely to continue kind of trading in this range. A couple of months back, I said that interest rates had peaked somewhere just over 7%, and I still believe that to be the case unless we continue to get disappointing inflation data. I honestly thought that interest rates would continue to trade in that range that we had seen, somewhere between 5.5%, mainly 6.5%, but said that they could go a little bit higher if we got disappointing data, and we did. We got disappointing data, and therefore interest rates have shot up close to where they peaked just a couple months back. And now that interest rates have moved higher, I believe that is going to continue to put further strain on housing. That big pickup that we saw in pending home sales in January isn't likely to last with interest rates moving back upward. So what we're likely to see is another round of slowdown in the housing market, which is going to take a couple of months to reflect on paper just because of how the data reports. So for the short term, you're going to get reports out that looks like the housing market is still strong, that there's a bottom in housing, when in all reality, we're likely to continue kind of just trudging through this process. Is trudging a word? I don't know, but we're likely to just keep going slowly through this process without seeing any big gains on the upside or any big gains on the downside. So why did inflation numbers disappoint so much in January? So why did we continue to see so much inflation? Why were the numbers so off? Why were economists so wrong? Well, one of the factors was how Shelter reports. Shelter inflation in January was up 7.88%. That's up from 7.51% in December, and currently sitting at the highest on record. At the same time, rent inflation for January was sitting at 8.56%, which is up from 8.35% in December, also sitting at a record. But here's the thing, CPI for Shelter has historically lagged home price changes by nearly 4 quarters. So even though home prices come down, which we've seen out there, that takes nearly 4 quarters to actually reflect in the Shelter data. And this lag is primarily due to how long it takes for leases to roll over into new contracts once a lease ends. And since landlords typically only renew contracts around every 12 months, that means that the new price dynamics don't actually reflect in these numbers for almost another year. So the question is, when will the rent Shelter data start to report correctly in the CPI numbers? Using the 12-month estimate number that they use, we could expect it to start to show sometime in May or June, but it's likely to heavily start to decrease sometime in July through the end of the year. In fact, you have the Boston Fed stating that Shelter inflation is set to slow to 5.88% in September from 7.91% in January. It is forecast to decelerate to 3.91% for the year ending in September of 2023. In fact, you can see from this chart here that services excluding Shelter are currently sitting under 2%, while core goods are officially in the negative. So once Shelter starts to catch up in May in the CPI numbers, we should start to see a meaningful difference in how inflation reports. But with that said, let's take a look at the current expectations from the Fed with regards to the Fed funds rate. Since our last video about talking about inflation, we've actually seen some changes in the probability of how far the Fed is likely to hike and when they're likely to start cutting. With the Fed's pessimistic comments about inflation not coming down and seeing Europe report higher than expected inflation numbers on their side, we've seen the Fed's final projected rate cut move to July of 2023. And here's the crazy part, it's now sitting between 5.5 and 5.75%. In fact, if you look at this chart here, on March 22nd, the Fed is expected to raise 25 basis points, taking us up to 4.75 to 5%. And that's currently sitting at 65%, with the other 35% expecting a 50 basis point hike at that time. On May 3rd of 2023, we're expecting another 25 basis point hike taking us up to that 5 and 5.25%. And as of today, that's sitting at 60% of interest rate traders expecting that 0.25% versus nearly 37% expecting a 50 basis point hike. Then in June, you have another 54% expecting another 25 point basis hike, taking us up to 5.25 to 5.5%. Then lastly, in July, at the moment, you've got nearly 41% expecting another 0.25% basis hike, taking us up to 5.5 to 5.75%, with about 35% expecting us to be a 0.25% lower at that time, and about 15% expecting us to be higher at that time. But here's the crazy thing. You've got nearly 35% of interest rate traders out there expecting a rate cut come December of 2023. So at the end of the day, these are all just probabilities. There's absolutely zero certainty in any of these numbers. If inflation continues to get out of control, then you're likely to see the Fed move their target even further. You're likely to see the probability move even higher. Whereas if you saw inflation data come down quicker than expected, then there's a really good chance that you could see traders back off those numbers and potentially see the target move down a little bit. But the idea of seeing an interest rate cut in December of this year, I don't think that's likely at this time, just based on the Fed's stance, wanting to keep interest rates high for the long term in order to make sure they're not making any mistakes. So if you're a buyer out there, a seller out there looking at the housing market, wondering what's going to happen, I wouldn't get caught up in the headlines. I would do what was right for me. Now that sounds very cliche, but you start reading the headline, you get really caught up in stuff that doesn't really matter in your personal life. If you're buying a house today, you have a longer term time horizon, you have money in the bank, chances are you're going to be really, really good. But if you're waiting for interest rates to come back down to 3% or something to buy a house, or waiting for house prices to crash, there's a really good chance that you're never going to buy a house, because the likelihood of that happening isn't very high. At the same time, if you're a seller out there looking at the market right now, waiting for prices to continue to shoot up before you can list your home, I don't see that happening. I think you're in a period where home prices are going to continue to move sideways, maybe a little up, maybe a little down, depending on your market, but you're not likely to see any sizable gains. So if you have to sell, right now is probably the best opportunity to get the most amount of money, at least in 2023, because there's not a lot of competition out there. There's less inventory on the market than just a couple of months ago, and there are still buyers out there looking. In fact, I've got a couple of different buyers looking. I've made 3 different offers in the past week, all been multiple offer situations, and we haven't gotten any of them. So I know the market is continuing to move forward. Now, if you're somebody just waiting on the sidelines, waiting for your right entry into the market, just waiting on the right house, not sure where to start, I created a first-time home buyer course to guide you through the process of buying a house. Everything from A to Z that you should know. And if you're waiting, right now is a good opportunity to take this time and learn, so that when you're ready to pull the trigger, you know exactly what you're getting into. So if that interests you at all, do me a favor and check the link below. Interest rates will continue to drive the market. If they go up, home prices will move sideways and probably even move down even further. If interest rates stall here, it will likely provide even more stability in the market. But if interest rates move down, you're likely to see the same thing that we saw over the last couple of months, which is a competitive housing market and prices continuing to stabilize, potentially even move up a little bit. But if you have additional questions on mortgage rates, where they're headed, what the Fed is likely to do me a favor and check out this video here.